Well, Miss Rebecca, thank you for coming in.
Yeah,
And
thanks for having me.
for those who do not know you or haven't met you yet or know who you're with, do you care to just give us a quick bio or intro for who you are, where you're working at, and all those things?
Absolutely. My name's Rebecca Elliott. I'm with Republic Bank. I've been doing home loans for about 28 years now. Been with Republic Bank for 10 of those. And I really love helping first-time home buyers. That's something I'm very passionate about.
So what do you think you love most about working with buyers?
Just the educational piece, to be honest with you. There's so many loan programs out there, so many options, and I love to dive into those and figure out what's going to meet their needs the best to help them be a successful homeowner.
So you say you've been with Republic for a little over 10 years.
Mm-hmm.
What do you feel like makes Republic stand out from, there's tons of different options out there. So what do you feel like makes you all stand out that's kept you there for 10 years? And
yeah, I'd have to say our loan programs. Being a local bank out of Louisville, we have what we call in-house loan programs. So those are specific to our bank. So it helps me fill a bigger bucket to help more people get into homeownership.
So do you care real quick to just expand on the difference in like an in-house loan product versus maybe something that would be more secondary market based? What does that look like?
Absolutely. So secondary market loans are your conventional loans through Fannie Mae, Freddie Mac. Then you got your government, which is FHA, VA, and USDA. And then in-house or portfolio loan programs typically are offered by local banks. And they're guidelines that the banks come up with to try to help achieve homeownership for more folks. So it's just very helpful. It's more options. It's more tools in my tool belt.
What would you say some of those programs, obviously you don't have to hit all of them, but what do you think there are some of those that you all get to utilize more because you have them?
Yeah. My favorite two is going to be our neighborhood housing loan. It is an income-based loan that requires 3% down, but there's no private mortgage insurance or PMI. It's got a super great fixed rate on it as well. And then it also has down payment assistance. So it requires 3% down, and we'll do down payment assistance to help you with the 3% down. And then my next one is actually for current homeowners. It's called a contingency relief loan. So if you have all your equity tied up in your home and you need that before you go buy that next home, it's a great tool to have to pull your equity out. So you're not doing a contingent offer. Go ahead and buy your house, and then when you sell your home, you can pay that loan off.
Do you feel like you guys are doing a lot of the contingency relief in the market we've been in for the last couple of years?
Absolutely. It's like the last 6 years, that's probably been one of our top loan products that we've had.
Do you feel like when you meet with those people, they're, surprised at the amount of equity they've been able to generate and that they can actually implement it or utilize it?
Yeah, it's definitely a surprise for them, and it helps to offset the cost of how homes have appreciated across the board. So you're going to be able to sell your house for more, which kind of makes you feel a bit better about having to go pay more for a home as well because of appreciation climbing so steep.
Well, and I think the biggest thing I have conversations with my clients about is, yes, you have seen that appreciation and you're typically shopping in the same market that you're purchasing in. Mm-hmm. So being able to create a vehicle that allows you to purchase without having to necessarily be contingent and have to maybe allow you to more, efficiently compete in a competitive situation on the house you're buying.
Right.
Sometimes that contingency can disqualify you if you're in a multiple offer situation or something. So I think that's a very good vehicle to have at your disposal to be able to use. And correct me if I'm wrong, but I can still pursue, am I able to qualify for a contingency relief product, but I don't necessarily have to use it unless maybe that scenario is demanding that I use it, right?
Yeah, it can definitely be your plan B. It doesn't have to be your first option. But yes, if you're going into a home that's going to have multiple offers, having a non-contingent offer usually helps a whole lot. So that could definitely be your plan B. And we can also talk about other options that you could do besides the contingency relief loan. I mean, there's lots of options out there to help utilize putting something down, maybe not as much as you want, but just getting it in the house, and you can refinance later, or you can do what's called a recast later as well.
I want to dive on a recast in just a minute. On the subject of figuring out what the best process is or the best package or option or offering is for the customer, what does that look like? Like, how do you all determine what the best course of action for a particular buyer is? Is there a meeting or a consultation, or what does that look like for you guys?
Well, that's kind of up to the client. I personally like to at least have a phone conversation or a sit down meeting, especially if we're going to dive into contingency relief loans and things like that, because you get into a lot of math, you get a lot of payments, and I don't want you to be confused. I want you to feel confident when you go and put that offer in. So definitely want to connect and talk to you, go over all your options. I usually try to offer 2 or 3 options to each client. Sometimes you can do 20, but I don't want to overwhelm you with it. So I'm going to narrow it down to what works best based off the conversation that we have.
So even if I'm not a fully ready buyer, which I think is relative anyways for where people are at in their buying adventure, it's still a good time to sit down and start evaluating, right?
Absolutely, and you don't have to do a pre-approval and have your credit pulled just to sit down and talk to a loan officer. You just want to have your ducks in a row, because with the way the market is, homes go quick. We don't have enough inventory still. So you want to feel confident when you make that offer, and you want to make sure you have as many questions answered as possible by your loan officer.
So unpacking that some for buyers that may be on the fence, or agents with buyers on the fence, I can go ahead and have a conversation, at least get a layout or an outlay of what my options might look like in preparation for shopping, and you would advise that.
Absolutely, and I think you would too. You need to be prepared. Don't go find the house first. Have the conversation with your real estate agent and with your loan officer, so that you're not going into something that you might not be able to afford, or you might not want that payment. Know what you can afford before you go out there, and then you're not going to be like, oh gosh, now I have to downgrade what I want, for a home.
And I think just from the agent's perspective, what I find a lot of times is, yes, this can feel very methodical or drawn out, and once I get it done, it's like I know all of my options.
Right.
So now I'm trying to find the best house for me, my family, or however my purchasing is going to turn out. I can make a more educated decision rather than fall in love with a house and then try to rush to put everything in place, which may not allow me to explore all the options. I may have to get put into whatever works at that point in time. Whereas I feel like I've seen you all do a very good job is going back to the fully ready buyer. Well, if you have some runway time there, I feel like it gives you some options to say, hey, maybe we can pull on this little debt lever here, or there's some things we can do over the next 30, 60, 90 days. So when you are fully ready and you're out shopping, you're in a better position to utilize maybe this particular option becomes more attractive because of the work you've done leading up to that. Is that fair?
That's absolutely fair. So
I know one thing that we are getting a lot of questions about right now. So while we're recording this, it's like start of March, which normally I feel like is when these welcome home funds have become available.
Yes.
So I want to unpack the welcome home fund with you.
Okay.
Your all's bank participates, correct?
Yes.
So for those who may not be familiar, can you explain what the welcome home fund is, just in a general sense?
Sure. So welcome home funds typically come out the 1st of March, but this year it's going to be April 6th. The grant, it is free money. It's $20,000. Each bank that participates is going to get $300,000. So that's 15 clients that have the possibility to get $20,000 in free money. You still have to qualify for a loan program, but the grant is income based and it's household income. So anybody over 18, we have to factor in their income. So if this is something that you think might help you, might benefit you, you definitely want to get with the loan officer that's participating with Welcome Home, get your income documentation to them now so that they can tell you if you do qualify for the program. But the funds do go crazy quick. Like April 6th, we'll probably utilize every bit of that $300,000. That's just how it goes.
And it's not just a Republic Bank thing.
Correct.
There's certain institutions in Central Kentucky who participate and get an allotment or an allocation of funds, correct?
Right. So the grant actually comes from Federal Home Loan Bank. So that's a bank outside of Republic Bank. But yes, they work with multiple banks, not just Republic Bank, and offer this grant.
So who would you say that grant is specifically designed to help?
You don't have to be a first-time home buyer to do the grant, but normally it's helping that first-time home buyer because that's $20,000 in free money that you can stack on down payment assistance, a gift that you might be getting from families. So it gives you more buying power per se because you have $20,000 extra to put in the transaction.
With it being a grant and it being, I'll call it forgivable, are there situations where it becomes non-forgivable?
Yeah, it actually comes with what's called a 5-year retention. So it means if you buy or sell your home in that 5 years, that you could have to pay back a proration of the $20,000. However, if you still are a low to moderate income buyer, normally you do not have to pay it back. So I've had a couple clients that have had to relocate due to jobs, and they've reached out to me panicked because they did welcome home funds, but by the time we submitted their pay stub to the Federal Home Loan Bank, they actually didn't have to pay it back.
Important distinction you made there, because some grants are due in full. So the fact that it can be prorated, it sounds like they're going to be willing to work with the consumer on
Absolutely.
what that payoff or lack thereof may look like, right?
Right, yeah. So it's prorated for 5 years. So obviously year 5, it would be more if you had to pay it back, versus year 1, it's going to be very nominal.
With respect to requirements, you mentioned some income requirements. Are there any geographic requirements to the Welcome Home Fund?
Now, you can use it in any county in Kentucky. So, geographically, there isn't limitations. However, each county has its own income limits. So you might be able to make X amount in Fayette County, but you can make more if you were buying in Montgomery County. This kind of depends on the county.
So what I'm hearing is it makes full sense to go ahead and sit down and start getting ready, because you said they come out on April 6th, they'll move quickly. What does that ramp up or that preparation time look like in your opinion, as far as if I want to have access to these, when should I be talking to you? Maybe when should I start looking at houses? Like, I know there's kind of a chronological order that you and I have discussed off camera that makes sense. Can you unpack that some?
Yeah, absolutely. So if you want to try to utilize Welcome Home Funds, I would encourage you to get pre-approved now. It is March. Get your income documents over, which are going to be pay stubs and W-2s of anybody that will be living in the house with you that's over 18. Get credit pulled, figure out what program we're going to be able to do for you, and then ideally a week or 2 before April 6th, get you under contract. Because to reserve those funds on April 6th, we have to have a signed contract to purchase, your income documentation, and a signed loan application.
So from that end of things, working with your realtor partners, typically are you seeing those contracts come in contingent on those funds, or is it more case by case whether they can qualify for or not? So it's kind of like, if I get them, great, I can utilize them, or is there some kind of a percentage base you could put to it? Like, I see 50-50 whether people do make them contingent or not. What would you say you see typically?
It depends on the client, honestly, because sometimes the client actually needs the $20,000 to qualify, and without it, they're not going to be able to buy a home. So we absolutely want to put in the contract that it's contingent on Welcome Home Funds. But if you could utilize down payment assistance or do something else, if the Welcome Home Funds didn't work out for you, you don't necessarily have to put it in the contract, and Welcome Home can kind of be your plan B. Like, if you get it, great, but if you don't, you have a plan A in place, to help you still get in there.
So I hear, again, preparation.
Yes.
So like, as long as I know I have options, because from an agent's perspective, that may make it challenging just due to the price point I'm likely shopping in, utilizing these funds. I'm probably going to be in the sub 275, 300 neighborhood, which is typically a pretty competitive price point for us, at least right now in the area that we sell in. So I would say from an agent's perspective or a consumer's perspective, 100% sitting down with you, your team, looking through what can I do with respect to these funds, but also in the event I cannot have access to these funds, do I have alternative methods? So I'm not writing a straight contingent offer, and I'll unpack that from an agent side. What that would look like, we would prepare that offer to purchase or the purchase and sale agreement, and we would have to form a rider or an addendum to that saying our offer is contingent on us getting these funds. Well, if you think about that from a seller's end, they may not be as apt to want to work with that over another one. It's not that there's anything wrong with utilizing those, and the seller has to think about, how do I get my highest and best as quickly as possible. So I think, I can't emphasize that enough as far as sitting down and figuring out what all options are available, not just these funds. And if you can utilize them, absolutely. Why wouldn't you?
And you made a good point with that, because even though the portal opens up on April 6th, and if we have a signed purchase contract and everything we need to get you in the portal in line to be reviewed by Federal Home Loan Bank, they're not going to review them on April 6th. It takes them 2 to 3 weeks on average to get through all the applications. You've got all these banks submitting that stuff. So, it's going to be well into the middle of April, if not the end of April, before we know if you have the Welcome Home Funds.
So drill down on that a little bit more from my end. I'm meeting with you as soon as possible if I'm a consumer, figuring out my options, starting to shop mid to latter part of March, looking to have a contract prior to April 6th. And whether or not we're going to put a contingency in there would be a case-by-case basis, right? And then April 6th hits, those get uploaded. So from my understanding then, that means that the loan actually won't begin being underwritten or processed until April 6th based on whether or not I qualify?
That's a great question. And actually what we do is we go ahead and get the file into underwriting. We have everything done to where we are just waiting on that commitment letter from Federal Home Loan Bank saying, yes, Mr. Client, you got your grant money, and then we can go ahead and close. So we'll go ahead, have the file underwritten, we'll go ahead and have the appraisal and title work done. But again, if you're going to do it subject to only getting the welcome home funds, this is only going to work out if you get the welcome home funds. You might not want to pay for your appraisal until you know that you've done that, So in that circumstance, we would need the approval letter from Federal Home Loan Bank and then get the appraisal ordered. So we would probably be able to close, a week or two out from that.
So let's drill down on closing, because I know that may be a question that comes up if I'm, if I'm writing my offer. Let's say I'm writing it March 23rd. And I'm looking at, on the contract, putting in maybe a closing range. So what I hear you saying is, depending on whether or not it is solely subject to, I could theoretically close within, mid to late April, depending on how that approval process works.
Right. So we are kind of at the mercy of Federal Home Loan Bank and how quickly that they can review everything and get back to us. So if you go under contract, I encourage the contract to give at least 45 days to close, if not up to 60. That way we have plenty of time to work on it. You can always do a contract extension, but just being upfront and transparent about how this transaction will have to go if you really need those welcome home funds.
So agents and consumers who are listening, paying close attention to what deadlines you're putting on yourself based on your particular client's needs and the loan that we are going to be utilizing then. So being lockstep and key with our lending partner in that scenario would be vitally important.
Absolutely.
From my standpoint. You said the funds typically run out quickly. So are there certain people who may qualify but they don't get them? Is that more emphasis on why you want to be looking at other options, exploring what those could be?
Yeah, absolutely. Because, let's say that we have your income and it's within $5 of the cutoff for welcome home funds in the county you're buying in. When Federal Home Loan Bank reviews your income, they might feel that you make $10 too much. And if that's the case, they're not going to give you the funds. I mean, we do everything we can to prevent that. But they have their own underwriters that are looking at income, hopefully the same way as we do. But, that could happen if you had a bad home inspection or if the home didn't appraise. When we reserve the funds, they're not just reserved to the client, they're reserved to that property. So if you walk away due to the appraisal or due to a home inspection, you lose the funds. And if there's any left over, because that does happen, financing falls through and then there's a waiting list for welcome home funds as well. So you might be able to get back in there or you might not.
I know you mentioned it's $20,000 per. Does that mean that they will utilize the entire $20,000, or is it based on the particular property or the price, or is it just those funds get allocated towards certain things? Like, may I look at it and maybe get $18,500, or how does it determine the amount that you get?
That's a great question too. So the minimum you have to take is $10,000. Most clients do the whole 20 because it's free money, so why not? And it can be used for the down payment, it can be used for closing costs and prepaid. So you can kind of bundle it all together. Again, you can stack it if you're getting a gift from your family. If you're doing down payment assistance through another type of loan program, you can just stack that $20,000, in addition to what you already have.
So important distinction there, it's not just the grant that you can utilize.
Right.
You can stack it.
Yep, absolutely.
Is that respective to your all's bank, depending on, what it is, or is that any bank that's offering the welcome home funds, or at least I know you can probably speak to your bank.
I can speak to what my bank does. I would think most banks would follow that as well, but for example, Kentucky Housing, they do down payment assistance of $12,500. So you could do that and stack it with the 20 and you have $32,500 for down payment and closing costs.
And that can make a really big difference in somebody's purchasing as well. Are there price limitations on the property?
No, there's not, but it is a low to moderate income program, so the likelihood of you qualifying for a $500,000 home is probably going to be pretty slim with the income limits. But again, the more you have to put down, I've done welcome home grants for teachers that had 20% down already, and then they got an extra $20,000 in free money.
So it sounds like maybe KHC, Kentucky Housing, down payment assistance is probably the best pairing with the welcome home funds because the way those funds are going to be used, right?
Right.
And does that primarily benefit your buyers who are trying to stay within a certain payment monthly? Is that usually the driver?
Yes.
Like, let's figure out how to maneuver those monies on the front end to get us to a comfortable range of payment on my monthly?
Yes. So welcome home funds in the past, I've done it two ways. I've had clients that say they qualify for $200,000, and that's just so hard to do, especially like in Fayette County. Well, having that extra $20,000, that pushes them up to $220,000. So that might open up some doors to be able to buy something, right? Or on the flip side, let's say that you qualify for $250,000, but really you want your house payment to be more along a purchase price of $225,000. Having the extra $20,000 can help get that payment down because you're putting more down. So it can go either or.
I like that. It just gives you options. In a market that has felt like buyers don't get a ton of options, it's certainly nice to be able to offer them. One thing I want to touch on, so we talked about some like income requirements and purchase price limitations and whether or not those things exist. Does the home itself have to meet certain criteria? I know there's certain loan types like government-backed programs where they have to meet certain health and safety guidelines.
Sure.
Is that the same with this particular scenario?
Yes, because the grant is just free money. So all you do to qualify for that is make the income limits, right? You still have to qualify for a loan as well. So if you're doing FHA with Welcome Home and you're buying an older home, and let's say there's 6 steps going down the outside door, there's going to have to be a rail there.
Okay.
There's peeling paint, it's going to have to be fixed. If you're going conventional, that's subject to what the appraiser sees. They go in and they see a big hole in the wall, they might note it, they might not. But yes, it does still have to meet conditional loan terms as well.
So what I'm hearing is agents and buyers alike still keeping my antenna up, not thinking I can go in and find some house that's maybe in need of repair, but I can get a price down because it's still going to have to meet my normal conventional FHA, VA appraisal requirements that they're looking at for the property. So I think that's an important note for people to pay attention to.
Absolutely. And sometimes, as you know, we can do what's called an escrow holdback from the seller or the builder for repairs. With the Welcome Home Grant, they don't do that. They don't want you to have repairs to the home. So that is something.
That's an important distinction to make for people to make note of.
Yes.
Let's see, when we're thinking about working with somebody local like Republic Bank versus maybe an online lender, not looking for you to dog anybody or give any kind of slander by any means, but what is the benefit of working with you guys at a local level as opposed to a bigger shop that might be West Coast based or nationally based?
The biggest difference is, when you go with an online lender, you're doing an online application, which you can totally do with a local bank like Republic as well. It's just a lot of times your income documentation, your bank statements and things are not actually being reviewed until it goes to underwriting. So an underwriter could catch something because you don't have an actual warm body looking at something like when you deal with somebody at a local bank. The other thing is, I'm out in the community. I run into my clients all the time. They mean a lot to me. We service the majority of our loans, so that means we're not going to sell your loan off more than likely, depending on the loan program. So I think that means a lot too, just knowing you can call me 5 years from now if you have a question on your escrow account or whatever, and I can help you out.
So when I'm thinking about all the things we've touched on, the main thing is that preparedness. So being able to have those in-depth conversations, looking at all the different options that could be open for me as a consumer, I feel like being able to sit down with you, whether it's in person or remote, would be a leg up when I'm evaluating all these things.
Absolutely.
From an agent's perspective, I see a lot of people that will come in who have clicked on something online and gotten an approval or whatever the case may be, and until we get that contract, then it seems like there's a mad dash to scramble and figure out how to piece the loan together on the back end. What I hear you saying is you all like to look at the full outlay on the front end and figure out this package stacked with this package, or do I qualify for this? So that way when I'm out shopping, I can focus on shopping, not how do I pay for it.
Right.
Is that fair? Is that something you run into a lot?
Absolutely. I actually just did a video myself this morning about that very thing. It's like, talk to a loan officer, talk to your real estate agent, and know what your payment's going to be before you go out there and start putting an offer in. So when you are under contract, you're not like, oh my gosh, I had no idea my payment was going to be that. I can't do that.
How often do you feel like you run into that?
I don't run into it very often, but I get a lot of phone calls from agents saying, hey, can you help this client out because we got them under contract and they freaked out when they found out what their payment was. So, when we do pre-approvals for folks, 9 times out of 10, we're also going to send out what's called a loan quote. So it's going to break down your closing cost and your prepaids. It's going to show estimated funds needed to close and, more important, estimated payment. So again, before you're going out there and looking, you've got that in writing to kind of see where it's at, ask me questions. I always encourage clients to reach out to me when you've got homes lined up that day to go look at 4 or 5 places. Reach out to me and give me those price points, and I'll tell you what those payments look like from the lowest to the highest, so that when you're going in making your offer, you feel as confident as you can.
I think that's a big one, because when knowledge is power, right? When I know what option makes the most sense for that property, I can then negotiate from a different place if I need to negotiate a certain way, as opposed to just write a boilerplate offer, hope it gets accepted, and then start trying to figure out, okay, how do we make this work for this house and this customer? So I can't emphasize what you just said enough. That makes everything run smoother.
Absolutely.
Because at the end of the day, I tell people this all the time, my focus is not on the house. That's the customer's decision to make. My focus is on making it as an enjoyable experience as possible, which usually just means avoiding as many of these roadblocks or stumbling points that I've seen other people go through, in an effort to just streamline that and make it as simple as it can be.
Right.
It's not easy.
It's not.
But we can simplify some of the easier to iron out wrinkles up front. I feel like if we just slow down before we start running and gunning.
Yes.
And it's actually, I don't know if you feel this way, I feel like I am seeing more properties come to market. We're entering into that spring market. And I feel like by them pushing the funds back a month, it at least allows there to be hopefully more of an influx of properties. And especially if you've got school-aged children, or you don't want to move right there, spring break, instead of going on vacation, I'm packing.
Right.
So I just feel like by pushing that back a month, I know that's not the reason they did it, but I feel like that's a beneficial byproduct of the pushback by a month.
Sure, absolutely.
With respect to the actual reasons why they pushed it back, you mentioned to me before we met that they were working on organizing the back end to be able to utilize some of that. Can you tell us, kind of in your opinion, what you see the benefit as to them moving it back a month, some of the stuff they're doing on the back end to make it easier for you guys?
Yeah, so they're working on updating technology to where when we upload things to them, it's getting into their system quicker and getting reviewed quicker. So that's the main reason for pushing it out a month. And we actually have our underwriting manager and assistant manager going and doing training with them next week too, which is something they don't always do. So they're offering some training pieces to just try to make the flow go easier. Because again, those funds can get over allocated really quickly. Sometimes they run out of money, and even though we did all the things that needed to be done, they just don't have enough funds. So they're trying to avoid that happening.
That being said, let's say that I have met with you, I've figured out and explored these different options, and let's just say they over allocate, or one of my clients does not get the welcome home funds. How long does that pre-approval last for them if whatever reason we can't get that particular property or we can't utilize the funds? Do they have to meet with you again and go over everything, or is their pre-approval good for a period of time?
Not necessarily. Yeah, so the pre-approval is going to be based off when we pull credit. So once we pull credit and get you pre-approved, that's good for 120 days or 4 months. And after that point, your credit just has to be updated. So if you found out you weren't going to get the welcome home funds, more than likely we're just going to switch a loan program. You have to redisclose some stuff to stay in compliance, and you should still be able to close pretty quickly after that.
Let's jump into some of those other programs. I want to drill down on, especially the neighborhood one.
Okay.
Can you unpack that particular program a little bit more for folks who are interested?
So Republic Bank's neighborhood housing program is specific to Fayette County and Scott County. It is income-based, but it's applicant income. So unlike Welcome Home, where it's household income, if a husband and wife, for example, make too much money together, They can't do welcome home funds, but they could do neighborhood housing if one of them qualified on their own with just their income and their debt. It requires 3% down. There's no private mortgage insurance or PMI, so that's going to definitely help the monthly payment. It's got a great fixed rate on it. And then we also will loan the 3% down payment requirement through down payment assistance.
So it seems like a great potential backstop for somebody who doesn't get those welcome home funds. Are there any additional requirements for the neighborhood program that may be different from, you mentioned the income, you mentioned the geographical, is there anything else specific to that program that maybe differentiates it when I'm looking at certain properties that may or may not be a good fit for?
So the property can't need a ton of repairs either. It is a conventional appraisal. But again, the appraiser could still note something that they see, and then it's up to the underwriter to decide if they want that to be addressed or not. But it is a conventional appraisal that we do. Seller can pay closing costs on it. You can get a gift as well. There's all kinds of options to help with that down payment as well. And you can also put more than the 3% down, because again, the more you put down, the less you're borrowing, the better that payment's going to be.
And that's not a finite program. That runs year round.
Year round, absolutely.
Okay. And really preparing for that is going to be preparing to see if you qualify for that program would be very similar to just a regular pre-approval.
Yeah, we would do an application and pull credit. It does require a 640 credit score. Make sure your debt ratio and everything checks out, and then after that you can get your pre-approval and start looking.
With respect to PMI, for folks who maybe have just heard it or heard their parents talk about it or think, well, if I don't have 20% down, it's all of a sudden going to blow affordability out of the water. What does PMI generally look like for a consumer? How do they calculate it or figure it out?
It's a good question. So private mortgage insurance is based off your credit score, it's based off how much you're putting down, and it's also based off the loan program you're doing. So there's a lot of factors that bake into it. Obviously, the better your credit score is, the better the PMI is going to be. Depending on the loan program, PMI can drop off once you get below 80% of the home's value, or it can stay on there until you refinance. So that's another reason you want to talk to a loan officer before you get out there and start looking at a house, just so you can ask those questions, because there's a lot with PMI. And believe it or not, there's a lot of first-time home buyers that think they have to have 20% down, and you don't. You don't have to have 20% down at all, but the catch-22 is typically you have PMI. But there are programs like neighborhood housing that don't require it.
So another feather in the cap for the neighborhood housing program. And what I have seen clients who do need to utilize PMI or are required to have the private mortgage insurance, is there a certain point that if you're in conversation with your agent and they say, hey, we've seen sales appreciate in your area, do they have to do anything special to eliminate PMI if they're currently paying it, or what does that look like?
You can actually request with your banker lender anytime that you want to get your PMI removed or reviewed. So if you bought a house, say a year ago, and you're noticing houses are selling for $20,000, $30,000 more dollars than what you paid, and that might get you out of having PMI, you can call your banker, your lender, and request that, and they'll give you the steps to take. And if you're below 80%, 9 times out of 10, they'll drop the PMI for you.
So important distinction there, because I have some people that are like, well, it should just automatically fall off. It's based off the borrower or the applicant driving the request for a review then.
Yeah. So if you do a loan program where PMI will automatically drop off, it's going to drop off once you're at 78% of the original purchase price. So if you're just making your principal and interest payment, and let's say you did 5% down, you didn't pay extra on your loan, your PMI is automatically going to drop off probably in year 9 to 11. But more than likely your house is going to be worth a lot more than that during that time frame. So it's definitely worth keeping an eye on what's going out in your subdivision so that you can try to get it dropped off sooner, because it's going to make your payment go down.
So we touched on just general time appreciation, which is the closest thing to real estate compounding interest that I can think of. What about if I move in something and I make some improvements to it, but when I bought it, it was less than some of the comparable sales? Do I get an appraisal and then give that to you all so the bank can have a consideration of value? What does that look like if we physically improve the property and not just over time allowed it to appreciate? What does that look like?
You can definitely request to have a full appraisal done if you've done some major work inside the home, and it's an additional fee that you'll pay, but again, the outcome of it is possibly getting your PMI removed. So it's definitely worth requesting that if you feel that it's going to help the value.
Let's just math it real quick, bar napkin math. I mean, if an appraisal costs $500 or $600 and I'm paying, let's just say $100 a month in PMI, I think that's a no-brainer if it can save me over the long term.
Absolutely.
So I think anybody who's listening who's in a house paying PMI and they're not sure if their property has appreciated, reach out to your agent, see if it has. And or if you've made those improvements, still reach out to them and say, hey, based on the work that I've done, is my house worth enough for me to reach out to the bank and see if that's something that can be dropped off of my loan?
Yeah.
Does that happen pretty quickly? Like the review, what's that review process look like? Does it typically take a month, 2 months, or what's that look like?
It isn't a very long process at all. Fannie Mae has their own procedures and Freddie Mac has theirs. So when you reach out to your banker or lender, they're going to see who is holding or insuring your loan, and then they'll tell you what you have to do based off that. And as long as you're proactive and get on the ball and doing it, it can happen pretty quickly.
Talk to me some about the down payment assistance through Kentucky Housing Corp. What does that look like? We've touched on the neighborhood housing, the welcome home funds. We briefly touched on the Kentucky Housing or KHC program with the down payment assistance. How does that work?
So Kentucky Housing is a nonprofit out of Frankfort, and they loan all over the state of Kentucky. They are income-based loans as well, but the income limits are a lot higher than most loan programs. And again, it's applicant income. Now, they do have a mortgage revenue bond program that has a lower interest rate, and that is based off household income, but there's some things you can do to work around even on that to try to get your client to qualify for it. But Kentucky Housing does conventional loans. They do FHA, VA, and USDA, but they will pair it with their down payment assistance or DAP, which is up to $12,500 that they will loan you to go towards down payment and closing costs. So it does help a lot with the burden of having to have your own funds to close.
Now, is that its own mortgage or is it with the first?
It is. That's a great question. So you would have your first mortgage, whether you're doing conventional, FHA, or whatever, and if you do down payment assistance, it is a second mortgage. And again, it's up to $12,500. You don't have to use that whole amount if you don't need it. And it's set up on a 15-year term. So I always tell clients, if you do down payment assistance and you want to pay extra on that down payment assistance, get that knocked out, and your payment's going to drop about $100 a month.
Are there typically any prepayment penalties with that?
No, most home loans do not have prepayment penalties anymore.
Important distinction if you've been talking to your parents or grandparents about when they purchased a house, because I get that question a lot. And to your point, more often than not, the answer is no, there are no prepayment penalties. So if you go with the down payment assistance through KHC, you're looking at a first based on whatever program you're in, and then a second. Are they making two separate payments because it's two separate notes?
Yes, absolutely. They have two separate mortgage loan numbers and everything, both payable to Kentucky Housing.
Okay. Is there anything that you would suggest for people who may be on the fence right now? We were talking before we started the conversation. It seems like buyer sentiment is lower than it ought to be based on some of these macro and microeconomic factors that we see. What would you say to a buyer who's on the fence right now about, is this the right time, or what should I be doing? I'm tired of renting, or I've thought about purchasing, I'm living at home, they're not a homeowner now. What would you say to that person to give them words of encouragement or just words of wisdom from doing it as long as you have?
Well, the best example I can give is I had clients last spring saying, I want to wait until rates go down in 2026. Everybody was hearing rates were going to get better in 2026, and they have. The catch-22 is that house that they were looking at last spring is probably worth $15,000, $20,000, $25,000 more dollars. So even though the rate's lower, your payment's going to be the same as if you would have bought last time. So I say that if you're comfortable with the payment, don't get hung up on interest rates. Owning a home is the greatest and fastest way to build wealth for you and your family. So have a conversation, get yourself educated, ask a ton of questions. There are no dumb questions. This is a big financial decision. You need to ask questions. You need to make sure you understand what you're doing, but I wouldn't wait. And, when spring and summer roll around, there's going to be a lot more people looking, and it's more competitive, and it's harder to get that accepted offer, as you know.
From her mouth to God's ear, that's the truth. I would say people need to start now, and that's not because I'm in real estate. That is just because we see it seasonally. It ramps up, it gets more busy. If rates come down, more people are looking because now more people qualify. Do you feel like, we said earlier, we're recording this early March, do you feel like conversationally you're having more conversations with people who are romanticizing the idea of purchasing this year? Conversations feel like they're up.
Absolutely. I mean, so far this has been one of the busiest years I've had in my career, and it has a lot to do with those rates dropping. So anytime that happens, it does definitely amp up things. So I feel spring and summer is going to be even more competitive than this year than it was last year.
I had my coaching call this morning, and my coach had just came back from our annual real estate conference, and Gary Keller, who's the chairman of our company, he's typically a doom and gloom guy when he's on stage. Like, you need to be prepared for a shift. You need to be prepared for things changing, maybe not so much for the better. And oddly enough, this year he was overly optimistic about the year ahead. And so I think what I hear you saying is most people are generally 60 to 90 days behind whatever the news is.
Right.
And so if I'm listening to Rebecca and I'm a consumer and I hear that she's having more conversations, my antennas are up that, hey, I have more competition arriving to the market with me as a buyer.
Right.
So again, not because we do this for a living, but just because we have seen the way things play out, and to protect the consumer's experience, if you're thinking about it, have the conversation now. It's no obligation to perform right now, and I feel like the more you know, the better decision you can make. Is that a fair assessment?
Totally agree. And as you know, with the way the market is, there's multiple offers on almost every property out there. So again, if you're more educated and more prepared to make an offer, I don't want to say rushing to have to make an offer, but you kind of do with the way the market is right now. So the more you know, the better you're going to feel about doing that.
And I think a lot of times people think because I do this for a living, I'm also not a consumer. I can definitely echo what you're saying. When we bought our first house as a married couple, I was like ready to pull the trigger. Let's do it right now. It's not going to get any better deal based on what we're looking at. This is 2015, so there were still deals out there. That being said, I remember we pulled over like 4 houses down, and my wife would shoot me if she was here for me telling this story, but she was like, I'm not ready to make a decision right now. And I had the conversation with the agent where there was somebody coming right in behind us, and they were fully prepared. Luckily, we had some of those conversations to where we knew what it took. All that being said, take my experience or my pain in that conversation and use it for the better of, we at least could get through that initial emotion that happens with every purchase. Even people who do this, we still have emotion.
Absolutely.
And then you can go back to, okay, it's math.
Right.
And math, as boring as it may be, it's black and white.
Right.
So if I have not just one option, but you've laid out multiple, then I can say, okay, house, need, where am I, what do I want to be, and how do I make it work? If I have all those, it becomes a yes or no, as opposed to, well, now I got to call Rebecca and do all that stuff she told me to do 3 months ago. So please don't be that buyer.
Right.
Be prepared, and then you can act. You're going to have an emotional decision to make, and then logic can kick in, and then it's just a matter of what works best for me.
Absolutely. Yep. And again, I mean, if you're paying rent, you're paying 100% interest. So don't get hung up on what rates are doing. Let's focus on the payment, make sure you feel good. And the average life of a mortgage is about 5 to 7 years. So more than likely you're going to refinance for some reason, or you're going to sell and move on because you've built some wealth, you've built some equity to where you can move and get that next house that you want as well.
I love it. And what is the best way for people to get in contact with you? So we know we got to get in there and get prepared. How do we get in touch?
You're more than welcome to give me a call, shoot me a text, send me an email. I've got a link to an online application as well, so I'm happy to share all that stuff.
And we'll make sure we put all your contact information and the link to the application in the comments and in the bio for the video itself. So I appreciate you helping us unpack this, and I'm excited for this year.
Thanks for having me.
Awesome.